SCHD is one of the most popular dividend ETF in the market. The Schwab US Dividend Equity ETF focuses on high-quality US companies with a strong track record of paying and growing their dividends. Launched in 2011, SCHD tracks the Dow Jones US Dividend 100 Index. It screens companies based on financial health, dividend consistency, return on equity, and free cash flow. This means you're getting exposure to large, stable businesses like Pepsi, Texas Instruments, Merck, and Verizon, names that generate reliable income. With the combination of low expense ratio, dividend focus, and quality filter, it makes SCHD a good contender for your journey to create wealth. Now, SCHD has faced several problems lately, and I will go through each one of them. And let's start with underperformance. The most common criticism it faces is that it has underperformed the S&P 500 in recent years. This underperformance mainly comes down to the difference in strategy between SCHD and the S&P 500. SCHD focuses on high-quality US companies with strong fundamentals and a consistent history of paying dividends. That means it leans heavily towards value stocks and mature industries like industrials, consumer staples, and financials. While these companies are stable and generate steady income, they typically grow at a slower pace. The S&P 500, on the other hand, includes the largest 500 publicly traded companies in the US and has a much higher exposure to fast-growing sectors like technology. Over the past decade, tech giants like Apple, Microsoft, Nvidia, and Amazon have driven a significant portion of the S&P 500 gains. Since many of these companies either don't pay a dividend or don't meet SCHD's strict quality screens, they are excluded from the SCHD portfolio or given minimal weight. As a result, SCHD misses out on a lot of the growth that has propelled the broader market higher. Looking at the 10-year mark, for example, 12.73% versus 10.82% annualized, this is just a 1.91% difference. And it may not seem as much right now, but when you invest for decades and assuming this difference remains constant, it's over 50% difference in performance. In my opinion, SCHD needs to enhance their criteria in order to outperform. Following with problem number 2 and related to number 1 is the allocation. One of the key reasons SCHD has been underperforming the S&P 500 comes down to sector allocation, essentially where the money is concentrated across industries. The S&P 500 is heavily weighted towards technology. SCHD, on the other hand, is built very differently. It focuses on dividend-paying companies with strong fundamentals and that has naturally filtered out a lot of the high growth, low dividend tech stocks. As a result, SCHD sector exposure looks more like industrials, energy, consumer staple, and healthcare. That makes up the bulk of the fund, with technology representing a big portion but is still not enough. So what happened is this. When the market is driven by growth and innovation, like it has been in recent years, SCHD simply can't keep up because it's not exposed to the biggest gainers. Instead, it holds mature companies that prioritizes paying dividend rather than reinvesting for aggressive growth. That makes SCHD great for income and lower volatility, but it also means it underperforms in strong bull markets, particularly ones led by technology and innovation. Problem number 3 is that SCHD tends to underperform the S&P 500 over the long term because bull run markets historically last longer than bear markets. SCHD is built with a defensive tilt. It holds high-quality dividend-paying companies that generally perform better during market downturns or period of uncertainty. That makes it a strong performer in bear market or sideways markets, where investor prioritizes stability and income. But here's the catch. Bull markets are both more frequent and longer lasting than bear markets. Historically, bull markets can run for several years, while bear markets tend to be shorter, often lasting just a month to a year. Since SCHD is underweight in high growth sectors like tech, it doesn't fully participate in those extended bull runs that drive the S&P 500 higher over time. So while SCHD might hold up better when market drops, it tends to lag during the long stretches of market growth, which makes a big difference over the course of a full market cycle. That's one of the main reasons why even with solid dividend and strong fundamentals, SCHD has underperformed the S&P 500 in total return over the recent years. Don't get me wrong, SCHD is not a bad investment at all. In fact, it's one of the best ETF out there for investors who care about consistent income, dividend growth, and quality companies. Just because it underperforms the S&P 500 right now, it doesn't mean it's failing. It simply means it's built for a different purpose. SCHD focuses on stability and long-term dividend compounding. It screens for companies with strong balance sheets, solid cash flow, and a track record of paying and growing dividends. That means it's packed with reliable names that can weather economic downturns and still reward shareholders. It may not not shoot up like tech stocks in a bull market, but it can offer peace of mind and dependable income, especially during volatility or when growth stocks cool off. If your goal is to return through aggressive growth, SCHD might not be your top choice. But if you're building long-term wealth with a focus on passive income and lower volatility, SCHD can absolutely be a strong core holding. It just needs to be understood for what it is, a dividend growth ETF, not a market-beating growth machine. When used as part of a balanced portfolio, it still brings a ton of value to the table. Now, I have one last question for myself. Should I buy SCHD? You see, in this YouTube channel, I track two portfolios. One that is fully invested in the S&P 500 and my dividend stock portfolio. My dividend stock portfolio is an evolving ETF that combines that sweet spot of capital appreciation and dividend growth. I carefully monitor my holdings and deploy contribution where it's needed the most, while manually reinvesting dividends. It has worked pretty good for me for having this combination, so to answer the question, no, I do not have plans to buy SCHD right now. I do think it's a great ETF, but where I stand as an investor, I don't see the fit for it. Now, if you're curious to see why my holdings are in my dividend stock portfolio that is currently beating the market, or follow my journey to 100K invested, make sure to check the following videos.